Hey, if you're looking to open a gas station and you are needing a set of financial projections, maybe for a potential lender or investor, well, you've come to the right place because we have built a financial projection template built specifically for gas stations. And so I'm going to walk you through how to use this template, how to fill it out. We have both the gas station and convenience store kind of sections to this template. I'll walk through each of those for you here today. Before I dive too far into this, a little bit of background. My name is Adam Huxema. I'm the co-founder of Projection Hub. And over the last decade, we've helped over 50,000 entrepreneurs create financial projections for potential investors and lenders. And today, we're specifically focused on this gas station template. I have put a link to this template in the description of the video below. And also, if you stick around to the end of the video, as a reward for that sticking around, I'm going to give you access to a coupon code that you can use to grab a discount on this template as well. So with that, let's go ahead and dive in. I'll show you how this works. Okay, so we're on the At a Glance tab to start with, and this is kind of the end of the process. So once we have filled out all of our assumptions, you'll be able to get these nice charts and graphs and tables, summary data of your projections. You can see some industry ratios, some key data points related to both your convenience store revenue and the fuel revenue of the gas station, some graphs and charts that you can throw into a business plan or a pitch deck. You'll also get a 5-year income statement summary, a 5-year cash flow summary, and a 5-year balance sheet summary, as well as an income statement, cash flow, and balance sheet report that's broken down by month for each of the 5 years. So you get that annual summary data, but also the monthly level detail if you need that. But we have a bit of work in order to get to that point, so we need to jump over to our Input Assumptions tab. I'll show you how to fill this out. So the first thing you need to know is that any cell that's highlighted in blue is an assumption cell that you can change. And so we've got our gas station and convenience store model here. And we are assuming this is a multi-unit model. And so if you are planning to open multiple gas stations in the future and you want to model kind of layering in multiple units, you can do that with this template. Now, also, if you just want to have one unit, one single unit, that's fine. You can just you can model a single unit as well. So I'll walk you through. I've put in some default data here for assuming a 3-unit model. So we are assuming that, hey, in month 0 here, we are going to invest $100,000 to get store 1 off the ground. And then month 13, store 2, $100,000, and then another $100,000 investment in month 25 for the 3rd store. We're also assuming a $75,000 worth of initial inventory. Now that could be both convenience store inventory or fuel inventory. You want to put what you expect to start out with on the day you open there. Now you'll have fixed assets. So we are assuming in this model that we actually don't own the property is what we're assuming in this model. Now you could own the property, have the whole build out and startup costs, which would probably be much higher than if you are purchasing the building, you own the land and the property and all that infrastructure. But in this model, we're basically just assuming that we are operating this gas station and we are leasing the facility. So we have leasehold improvements that we assume we're going to put in $50,000 per store for each of those stores. And you can see that follows that same month 1, 13, and 25. And we're going to put in a $30,000 refrigeration unit in each store in month 1, 13, and 25 as well. And then next, we're going to have we're going to take out a business loan for each of these stores as well. So $150,000 business loan in month 1 for the first store, and then $100,000 for the next 2, because we're hoping that we'll have some positive cash flow from the first store, so we don't need to borrow as much for store 2 and 3. All right, let's jump over to the Input Revenue tab here. Now we can assume how many days you'll be open. Now you may be open 7 days a week. That's probably the case. Now you can enter in the months that you would open. That month 1, 13, and 25 is what we've been kind of following that pattern. Now here we can say how many visitors per store per day do we expect. So what we have done here is kind of a default is assume that, hey, in the first year, maybe the gas station is in a growing trafficked area. And so maybe in the first year, we only expect 600 visitors a day. But as more traffic in the area increases over time, we think we're going to increase our visitors to 650 and then to 700, and maybe we plateau at that average of 700 visitors a day. And since this is you don't probably go to a gas station and not buy anything very often. You're usually going to either get something from the convenience store or to purchase gas. We're going to assume a 90% of visitors are actually going to purchase something. And now we can put in the number of products that we assume per transaction. And so this is for the convenience store portion here. We assume on average, the 600 visitors here are going to purchase 1 product per transaction or per visitor. as well. So what we want to be clear about here is that we know that some customers are going to just buy fuel, right? And so you want to keep that in mind, that it might be that of the people that actually buy something from the convenience store, maybe they buy 2 or 3 or 4 items on average. But there's a whole chunk of people that are not buying any items from the convenience store at all. And so we're saying that on average, taking everything into account, some people buy several items, some people don't buy any items. We're saying on average, 1 product per visitor, basically. And that breakdown of those products that are purchased from the convenience store here is broken down here. So we've got these different products with an average price point for each one. And then this is your cost. What does it cost you? So we're saying for tobacco products, basically your cost of goods sold is 35%. If it's a $10 item, your cost is $3.50. And then here, this is a little tricky, but this is where you enter your relative popularity of the item. And so if we add all of these numbers up, it adds up to 21. And so what you're doing here is saying 5, by putting in 5, you're saying 5 out of 21 items that are purchased are tobacco products. 1 out of 21 items are alcohol. 3 out of 21 items are packaged food. So basically you're putting in kind of your relative popularity. Now, let's say that all these 10 items all get sold completely evenly. Just every person buys 1 item of each, let's say. If that was the case, then you could just put in 1 in each of these, have it equal. The relative popularity is the same for all of them. It's just 1. There's no differentiation. So that's a little bit of a confusing concept sometimes. And so if you have questions about that, feel free to reach out. But you can reach out to us at support@projectionhub.com, and we can try to help clarify any of that if it's confusing for you. All right, so based on that, then you'll be able to project your convenience store revenue here. And now we are getting into our fuel revenue. And so what we're assuming here is that we're saying what percentage of the visitors, convenience store visitors, and that's these visitors up here, what percentage of those visitors are going to purchase fuel? We're saying 85% are purchasing fuel. And we have the same kind of breakdown here of the fuel category, unleaded, premium, and diesel. And we have the average purchase value. So this is like, what does it take to fill up the tank on average for these different fuel categories? And then what you'll want to do is enter in your cost of goods sold for that fuel. So what I've done up here is I've assumed a 95% cost of goods sold here for the fuel. And again, we'll do that same trick here of the relative popularity. So I've got unleaded at 3. Now that's 3 out of 6 here. So that's basically saying that 50% of your sales will be unleaded. 1 out of 6 will be premium. 2 out of 6 will be diesel. And that will allow you to forecast your fuel revenue. All right, now jumping over to our input operating expenses, what you'll be able to do here is enter in expenses as a fixed dollar amount. So we could say our ad budget is $750 a month, or a per store amount. So for accounting, let's say we think it's going to cost us $500 a month to do the accounting for each store. And so as each store is added into the model, this model will automatically add $500 worth of accounting expense to your expenses. And then the last way to model expenses is on a percentage of revenue basis. And so we have set the credit card processing fee at 3% of total revenue. And so we are assuming that you're going to pay 3% of your total revenue as a credit card processing fee. Now, if you have a deal where with a credit card, because you're high volume, you might get slightly lower than 3%, and it really could make a difference. You might want to put in maybe it's 2.5%. Change this to 2.5%, because that on high dollar volume, at a gas station, that will make a difference. All right, and then we have on the input salaries and dividends tab here, we're assuming a regional manager, so one regional manager that's kind of overseeing all 3 stores. And then we have per store staff team. So we're assuming a 1 store manager, and then 2, you can see here we have staff at 30,000 annually, and we're saying there's 2 of these staff members. And it could be that you might have 10 different part-time staff that are all paid $5,000 each, because they're all just working little shifts here and there. And so you might want to enter it that way. You could do that. You could say, we have staff that make $10,000 annually because they're part-time, and we've got 8 of them or something like that. So you could make that change as well. Okay, so we are done now. We can go back to our at a glance tab and we can see what our numbers look like now. One thing I'll point out is you just want to make sure that your net income percentage is not too high. It's a gas station is typically a low margin business, right? Because you're not making a high profit margin on the fuel sales. Maybe you are on the convenience store, but overall, as a percentage of revenue, that net income percentage is probably going to be in the low single digits. So keep that in mind. If you get done with this and you're showing a 40% profit margin, you probably did something wrong. All right, thank you for making it to the end here. So like I had promised, you can go down to the description of the video below, and there will be a link to a form. You can fill out that form, and we are going to send you a discount code, our most up-to-date discount code, so that you'll be able to use that at checkout and take a discount for making it here to the end of the video. So if you have any questions at all, please don't hesitate to reach out. Leave us a comment in the comment section below or reach out at support@projectionhub.com. Thanks.